So central banking and central banks have various tools at their disposal to undertake monetary policy. In the case of the Central Bank of Europe, to control inflation, and in the case of the Fed in the United States, to expand output and to decrease unemployment and whatnot. Now, these three traditional tools are the following. The first is what we call open market operations, and we'll see what this is in a minute. And for the Fed, these are decided by what we call the Open Market Committee. That's the board plus the 12 Reserve Bank presidents. They work together to define this open market operation. We also have reserve requirements. We mentioned what reserve requirements are. So the banks need to maintain a certain amount of money on hand to cover demand deposits, and those are reserve requirements. And a little thing called the discount rate. So let's take a look and see what all these are. First, let's take a look at open market operations, and we start with a bank in this situation. So we have our central bank over here, and we have a bunch of commercial banks over here. And in the bank's balance sheet, what do we see? We see a series of assets. These assets could include, for example, bonds. So here the bank has invested in government securities, government bonds. And these pieces of paper, basically the bank gave money to the central bank. In exchange, the central bank gave them these pieces of money. These are investments, and they earn a very good rate of interest, probably a very guaranteed rate of interest. They're giving money to the central bank, and the central bank is giving them a piece of paper called a bond. And because the central bank has their money, they're going to give them the commercial bank interest for their money that they have. Secondly, commercial banks have reserves on hand and cash on hand. Some of these reserves are required reserves. We have them here. We can't touch them because we have checking accounts and we need to make sure we have money for our customers. Some of them are excess reserves, we call that, or excess cash on hand, and I can loan that out, I can keep it, I can do what I want with it. And lastly, banks have made loans to businesses. So they've taken money they've got, typically excess reserves, and they've loaned it out to businesses and households. And if they loan the money, they get the interest later on that these households and businesses will give them. So banks have given money to the central bank. In exchange, they get a piece of paper called a bond, and that pays interest to these commercial banks. Secondly, they have cash. They have required reserves and excess reserves. And they also loan money out. In exchange, they get interest payments from investors and people that have borrowed money to buy a car or something like that. And I want to bring out here also in our diagram, we've got the market for loanable funds. The supply of loans can come from banks, but from other places as well. And this is the demand for money. People want to borrow money, and we have the demand as interest rates decrease here. We see that the quantity, obviously, demanded of loanable funds increases, and we're currently in equilibrium. So let's take a look at and see how open market operations work. So we're going to consider the case of an expansionary policy, and to expand the economy, we're going to see that the Fed will buy back bonds from banks. Remember, these are these pieces of paper that they have. The central bank has their money, and this is a promise to earn interest for giving the central bank its money. And these banks have these pieces of paper sitting around. It's called a bond. So how does this happen? So the central bank basically makes an announcement and says, I'd like to buy back the bonds for you at a good price. So I know I can earn a certain interest on the bond. The central bank is going to pay me the interest, but now they're offering me to buy these back from me at probably a better price. And so because banks want to make profit, they're going to say, okay, I'm going to sell you back one of my bonds. So they give back the piece of paper. And in exchange, the central bank gives them their money back, plus probably a nice sum of interest to boot. So they're buying back the bond, and this money then arrives in the bank. So the money arrives in the bank in the form of reserves, and the bank can loan this money out because it's met its required reserves. It can't touch these reserves here, but now suddenly I have extra reserves. And as a result, the supply of money that can be loaned in the money market increases. And this basically results in a decrease of interest rates, and the quantity of loanable funds will increase. So interest rates fall as, well, the banks have got all this money. How will the bank get people to borrow this money? And, well, they're going to lower the interest rates to attract people to come and borrow that money. And we all know what low interest rates mean. Low interest rates basically increase consumption and increase investment by government, by businesses. So these lower interest rates will push up two very important components of aggregate demand: consumption by households and investment by businesses. And so we see demand increase, and we can see here that we've moved up to this different point, the new equilibrium, where prices are actually higher than they were before. But we've increased GDP. We've increased the equilibrium of GDP. That's expansionary monetary policy with an open market operation of buying back bonds from banks. Now, what about contractionary policy? Sometimes we want to contract the economy. Well, we're going to do the exact opposite. In this case, the central bank says, hey, I'll sell you a bond with a great interest. Okay, so hey, I'll give you a nice interest rate. I want to sell you a bond. And the bank here has, we get some cash sitting around. Let's buy the bond. So the money flows back to the central bank, and they recuperate a piece of paper in the form of a bond. But, well, let's take a look at the amount of money. Suddenly, I don't have as much reserves on hand to make loans. I can't make loans. And so the supply of money available to be loaned out decreases. And as the supply of money to be loaned out decreases, well, the interest rate rises. And we finish our story. Because interest rates have gone up, well, aggregate demand is now going to decrease. Because interest rates are higher, investment will decrease, and consumption or borrowing to consume will also decrease. And so we see a decrease in aggregate demand, pushing prices down and pulling GDP back. So those are the two types of open market operations, and they typically involve the buying and selling of bonds to commercial banks. Now, the second tool of monetary policy are these required reserves. Remember that these are this is an amount of money that banks, commercial banks, need to keep for their depositors. If a depositor comes to the bank and says, I want my money, well, you got to have some on hand. And I told you before that this money is not really at this bank. It's saved over here in the central bank in their bank account with the central bank. So what happens if the central bank says, hey, you don't need to hold this amount of money, maybe you can hold less. And so the bank, the central bank, changes the required reserve ratio. They can raise the required reserve ratio, and this will decrease supply. So we're in a situation where we have required reserves. Now let's look at expansionary policy. If the central bank says you do not need to keep as many reserves, you can have fewer reserves on hand, then this money here becomes available to be loaned out. And as this money becomes available to be loaned out, the supply of money increases to be loaned out, the amount of money that can be loaned, and interest rates drop. And again, as interest rates drop, investment increases, people borrow money to consume, and this increases demand. We can do the exact opposite. We can increase the required reserve ratio, and that contracts the amount of money available. We move backwards to a higher rate of interest. So those are expansionary and contractionary policies using required reserve. Also, just remember that the federal funds are there. That money that are requiring for people to have is stored in the central bank. It's rarely stored on site in the banks. Banks, if they need money to meet their required reserve ratios, can borrow that from other banks. And so you can imagine, the Federal Reserve has all these accounts, and there's some federal funds from one bank in an account, another in another account. And if the Fed, let's say, raises the required reserve ratio, a bank may be in need of money to meet its required reserve ratio, and it can borrow the federal funds that one bank has if maybe one bank has too much reserves, and they pay an interest rate, and that's called the federal funds rate. And this is literally done evening to evening. So the last policy that does exist is using what we call the discount window. So the central bank is here. It has money. It can print money. It can make money available. And they have a window, a teller. And this window is there to serve the needs of commercial banks. And so the central bank can loan money to commercial banks at what we call the discount rate. And that's the interest rate that banks will pay. And it's quite simple exercise. The discount rate, the discount window is here. And the central bank basically announces, hey, you know what? I'm going to lower the rate. I'm ready to loan money at a low rate. Do you want to borrow some money? And the banks can say, yeah, sure, I'll borrow some money, because then I can loan it out to consumers and businesses at a higher rate. I'll make some money. So they borrow money at a low rate from the Federal Reserve or the central bank through the discount window. And as a result, what happens, the supply of money in the economy available to be loaned out increases and rates fall. And we know what happens there is that as rates fall, well, investment increases and consumption increases. People borrow more money. So we can lower the discount rate. Now, this type of policy using the discount rate is rarely used anymore. The primary type of monetary policy that exists today in the economy is principally open market operations.